ለመማር ወደ ትምህርት ተቋም መሄድ ግድ አይደለም።
ናሽናል አቪዬሽን ኮሌጅ
ራሳችሁን ከኮሮና ቫይረስ ወረርሽኝ እየጠበቃችሁ በቤታችሁ ወይም በተመቻችሁ ቦታ
በኢንተርኔት አማካኝነት በኦንላይን ትምህርታችሁን መከታተል ይቻላል።
ካናዳ ከሚገኘው ኢንተርናሽናል ኤር ትራንስፖርት አሶሲዬሽን አያታና
ከእንግሊዙ ኢንስቲትዩት ኦፍ ኮመርሻል ማኔጅመንት ICM ጋር በመተባበር የሚሰጡ ትምህርቶችን ተከታትላችሁ በ6 ወር ጊዜ በዓለም አቀፍ ደረጃ ተቀባይነት ያለውን የስልጠና ማስረጃ ባለቤት መሆን ይቻላል።
ከኢትዮጵያ ሲቪል አቪዬሽን ባለስልጣን ሙሉ ዕውቅና ባገኘንባቸው የፍላይት ኦፕሬሽን እና የሆስተስ ስልጠናም በምዝገባ ላይ ነን።
ጥያቄና መልስ፣ የክፍል ስራዎች ብሎም ፈተና መፈተን ክፍል ውስጥ እንዳላችሁ አይነት
ልምድ ባላቸው መምህራን እየተማራችሁ
በኦንላይን ባላችሁበት ቦታ
አድራሻ ከ22 ማዞሪያ ወደ ሾላ ገበያ በሚወስደው መንገድ 150 ሜትር ገባ ብሎ ናሽናል አቪዬሽን ኮሌጅ
የናሽናል ኤርዌይስ እህት ኩባንያ
ህልሞን እውን ያደርጋል።
Good afternoon.
Good afternoon, doctor.
How are you? I hope
and welcome.
I hope my today's voice is clear.
Yes, it is good, clear.
Okay. I think it is better to start from the beginning because previously there was network interruption. The chapter 2 is about capital budgeting decisions, and in this chapter we'll see what do you mean by capital budgeting, and we'll see capital budgeting techniques. Capital budgeting, just to revise, it is budget for the acquisition of long-term assets. We can define it in different ways, but in simple terms, capital budgeting means a budget for purchase of long-term resources. Maybe for the purchase of building or the construction of building, maybe for projects, new projects. And simply, if the assets are going to serve the organization for more than a year, those assets can be referred as capital assets. Budget for those assets can be referred as capital budgeting. So capital budgeting, it is a process of analyzing investment opportunities and making long-term investment decisions. It's the process of making investment decision in capital expenditure. The capital expenditure is the benefits of which are expected to be received over a period of time. This capital, the term capital refers to the long-term nature of that expenditure. If we purchase building, for example, the return from that building is in the long term. So capital budgeting decision involves evaluation of projects. When you say evaluation, we are referring selection, which should be accepted. If there are different alternative projects, for example, we have to select one. So here our goal is to accept a project which maximizes the shareholders' wealth. That is the ultimate objective of managing business organizations. Can you hear me? Can you hear me?
Yes. Yes.
Yes, doctor, we can hear you.
Now you're okay.
Okay. So these are examples of capital expenditures. For example, cost of acquisition of permanent assets. When we say permanent assets, we are referring long-term assets. Assets that will serve the organization more than a year. Buildings, equipment, machineries, and the likes. If land is, for example, private property, land can be considered as a permanent asset. But in our country, land belongs to the government. Cost of addition is a capital expenditure. For example, addition, if we are interested to add on a building, or if we are interested to add on our manufacturing plant, addition, expansion, improvement of alteration in fixed assets. For example, if there is a building initially designed for offices, and if you are interested to redesign that building into classrooms, this is capital expenditure. The cost of replacement of permanent assets is the capital expenditure. For example, if there is old machine, and if you are interested to replace that old machine by the new one, this is capital expenditure. The purchase price for the new machine is capital expenditure. Research and development projects, these are capital expenditure decisions. Research and development. If we have a budget for research and development, for example, research and development, maybe to develop a new product, it requires huge amount of expenditure, but the return is in the long term, in the long run, after producing a product. So these are examples of capital expenditures. And before directly moving to investment selection criteria, it is advisable to identify the nature of projects. The nature of projects. Some projects are independent, as the name implies, they are independent. A project whose acceptance or rejection does not prevent acceptance or rejection of another project. For example, if there are two projects, let's assume project A and project B. If both are feasible, we can accept both independent projects. Dependent projects, a project whose acceptance depends on the acceptance of one or more other projects. For example, if there are two projects, project A and project B, if they are dependent, to accept project B, first we have to accept A. So accepting A is a precondition for accepting B. If projects are in this way, we can refer those projects as dependent. The acceptance of one will depend on the acceptance of the other. Mutually exclusive projects, as the name implies, they are mutually exclusive. If we accept one, we have to reject the other. That means, for example, if there are two projects, project A and project B, if we accept A, we have to reject B, or vice versa. If we accept B, we have to reject A. If projects are in this way, we call these projects mutually exclusive. So we have to know the nature of the project. The nature of the project will affect which project should our company accept. So why capital decisions or capital expenditure decisions are important? We have to be careful at the time of capital budgeting decisions. Here I'm using capital budgeting, capital expenditure interchangeably. Don't get confused. They are the same. Capital budgeting decision, capital expenditure decisions. These capital expenditure decisions are very important. And what is the reason behind this? One is they influence the firm's growth in the long run. For example, if it is to invest in a new project, it is very important because that project will affect the firm's growth. If our capital budgeting decision is poor, it will deteriorate the wealth of the organization. It is against our goal. If our capital expenditure decision is good, it will have positive effect on firm growth, and it will have positive effect on wealth maximization. So we have to be careful at the time of capital expenditure decision. The other reason why this capital expenditure decision is important is they involve commitment of large amount of fund. For example, assume a simple construction of building, new building. It is a capital expenditure decision. To construct a building, you can imagine the amount of fund required. So it requires large amount of money. And they are irreversible. For example, once we start the construction of building, it is difficult to reverse it, difficult to cancel it. Even if it is possible to cancel it, it will have substantial loss. For example, once we start construction of building, and if we are interested to refrain from the construction process, there is loss. So we have to be careful initially at the time of capital expenditure decision. And they are among the complex decisions to make. They are complex. Capital expenditure decision is complex. One thing that makes complex is time gap between initial expenditure and return. Time gap. The expenditure is today, the return is in the long run. So we're spending money today by expecting future return. And the future is usually uncertain. And it is difficult to compare our initial investment with the future money. This is one of the reasons that will make this capital expenditure decision complex. So as a manager, we have to give special attention to capital expenditure decision. In capital expenditure decision, we have to know the cash flow trends. cash flows. There are two types of cash flows in capital budgeting or capital expenditure. The first one is initial cash outlay or initial investment. For example, to construct building, there will be initial investment, the construction cost. For example, if we spend 10 million to build a new plant, then the initial outlay or cash flow at year zero, we can call it, is 10 million. And we can express in negative form because the company is paying. It is outflow. So it will reduce the company's cash. Another cash flow expected from capital expenditure is annual cash flows. Annual cash flows after tax. For example, if it is a new project, a manufacturing company, for example, initial investment will be there. After that, periodically, there will be sales. Sales. If it is service giving activity, there will be revenue from service. And cash will be generated from that. At the same time, there will be cost. For example, to sell a product, first we have to produce a product. To produce, we have to purchase raw material. We have to purchase raw material, we have to pay for labor, we have to pay for overhead. These are costs. So our net cash flow after the initial investment is the net one. Cash received from sales minus cash paid for costs. This is the net cash flow for the organization. At the time of selling products, the company will generate cash. That is inflow. But to sell that product, the company must incur cost. So cash outflow is there. So the cash flow after the initial investment is net cash flow. Inflow minus outflow, that means. Inflow from sales minus outflow for costs. So these are the two cash flows expected from and expected for capital budgeting. That is the initial cash flow and the net cash flow. The net cash flow after the initial investment. So the main thing that we have to do at the time of analysis is compare your initial cash flow, initial cash outflow with net cash flows expected from that project. And there are different techniques or methods of capital budgeting. These techniques can be classified as traditional and time-adjusted techniques. Traditional and time-adjusted. The traditional one, commonly used methods, payback period method, average rate of return method, or accounting rate of return. These are traditional methods. Time-adjusted or discounted methods, NPV or net present value, internal rate of return, and profitability index. Profitability index. These are methods. Time-adjusted or discounted methods. Three. So we'll see these three methods. From the traditional methods, one is the payback period. The payback period is the length of time required for a project's cumulative net cash flows, net cash flows after tax to return its net investment in a project from operational resources. For example, if our initial investment is 10 million, it is negative. Another cash flow is the net cash flow from the project. Payback period means the period of time required to recover this 10 million from the cash flows of project. Payback period, as the name implies, the amount of time that the project requires to cover its initial investment, the payback period. The decision rule, if we are using payback period, is accept the project if the actual or computed payback period is less than the maximum payback set by the firm. For example, if your firm sets the maximum payback period as 5 years, a project with payback period less than 5 years will be accepted. The lower, the better. Assuming that those projects are independent. So this is additional. We'll see it by using an example. In ranking two projects, if there are two projects, for example, having the same maximum allowable payback period, the project with shorter payback period should be chosen because it pays for itself more quickly. Let's continue the previous example. If the firm's maximum payback period is 5 years, if there are two projects, let's assume project A and project B, if the payback period for project A is, let's say, 3, payback period for project B is, let's say, 2. Which project is preferred? Is there anyone who can answer this? Are you with me?
B.
Project B. Project B. The reason is? What's the reason?
The shorter the payback period, that to be reinvest for the next year.
The shorter the payback period.
And
So,
the reinvest, yeah.
Yeah, we can reinvest it. That means we need only 2 years to pay back our initial investment or to recover our initial investment. But for project A, we need 3 years to recover our initial investment. So since both are less than the maximum payback period set by the company, both are acceptable. But if we are choosing one, we have to choose a project with shorter payback period. Our projects are ranked according to the length, their payback period, and the length of payback period, and the shorter the coverage, time is preferred. For a single project, if there are no other projects, if the company is having only a single project, the payback period is specified by the management. That means the management's maximum will be compared with the project's payback period. If it is less than the maximum payback period set by the management, the project is acceptable. So this is the essence of payback period. Let's see it by using an example. I hope it is visible. We have seen this previously. For example, there are two projects, project A and project B, and the initial cash outflow, by the way, in accounting, if it is presented in bracket, that means it is minus. So in cash flow, it means it is outflow, negative. The company's cash will reduce that. Project B and project A are having the same initial investment, but when you see the cash flow after the initial investment, this is a time. You can consider this as years, year 1, year 2, year 3, year 4. For project A, it is 3,500 net cash flow. That means cash inflow minus outflow. The net one is 3,500 per year. For project B, 500 for year 1 and 2. For year 3, 4,600. For year 4, 10,000. The required is to calculate the payback period. If the project is having equal cash flow, like 3,500, it is easy to calculate the payback period. Payback period, if the cash flow is the same. Payback period, which is equal to cash flow or initial investment divided by annual cash flow. That means 10,000 divided by 3,500. This is. What will be the result? 10,000 divided by 3,500. What's the result?
2.86.
Sorry?
2.86.
2.86 years. This is the payback period. So it is presented in this way. But it is easy to calculate like this. If the cash flow is the same, the payback period is initial investment divided by annual cash flow. Or you can calculate the payback period in this way. For example, at year 0, it is negative 10,000. In the first year, 3,500 will be recovered. So 10,000 minus 3,500, the remaining balance will be 6,500. In year 2, 3,500 will be covered. So 6,500 minus 3,500, the remaining balance will be minus 3,000. 2 years. Up to year 2, 3,000 is, 3,000 remaining. But in year 3, the total cash flow throughout the year is 3,500. But to recover, we need only 3,000. Only 3,000. So up to this, it is 2 years. That means to calculate the remaining year, it is the remaining balance divided by the annual cash flow. The remaining balance divided by the annual cash flow. The remaining balance in this case is 3,000. The annual cash flow is 3,500. Look, the remaining balance, this one. Another way of calculating payback period. It is already calculated here, but another way is up to year 2, only 3,000 is remaining. That means 7,000 is covered. In year 3, the total annual cash flow is 3,500. But uncovered portion is 3,000. So the remaining balance, 3,000 divided by 3,500. What's the result? 3,000 divided by 3,500. Can you tell me?
0.86.
0.86. That means 0.86. So the payback period is 2 plus 0.86. The result is 2.86. This is another way to calculate payback period. This process is appropriate if the cash flow is not even. It's not constant like project B. But if it is constant like project A, you can calculate this by using the first formula, this formula. So this method is appropriate to calculate a project with uneven cash flow. Project B, let's see. The initial cash flow, outflow that is 10,000. We're going to calculate payback period for project B. In the first year, 5,000 will be covered. So 10,000 minus 500, not 5,000, 500. 500 will be covered. So the remaining portion is 9,500.
9,500.
9,500 remaining. In year 2, 500 will be covered.
9,000.
9,000 remaining. In year 3, 4,600. 9,000 minus 4,600.
4,400.
4,400. So up to year 3, that means. In year 4, the annual cash flow is 10,000, but only the uncovered portion is only 4,400. So we don't need the full year to recover 4,400. So calculate the remaining balance, calculate the portion of year required to cover 4,400. Remaining balance 4,400 divided by annual cash flow in the next period, 10,000. 3 years plus the result of this will be the payback period. What will be the result? 4,400 divided by 10,000. What's the result?
0.44.
0.44. That means 3.44. 3 years, this one, plus 0.44, 3.44 years is the payback period. The payback period is 3.44. Is that clear?
No.
Is that clear?
Yes.
Okay. Which project is preferable? Assume they are mutually exclusive. That means if we accept one, we have to reject the other. Which one is preferable?
Project A.
Project A, because the payback period is lower than project B. the payback period is 2.86 years. Project B, the payback period is 3.44. We need more here. So project A is preferred. So this is the process to calculate payback period. By the way, these methods are common even in our country. At the time of asking loans from, for example, development bank, these techniques are applicable. But it has some advantages and disadvantages, this payback period. The advantage is it is easy to use. It's quick and dirty approach because it has its own limitations. We'll discuss about that. It is easy to calculate number of years required to recover our initial investment. It emphasizes liquidity and crude measure of risk. It emphasizes liquidity, emphasizes the availability of cash to recover our initial investment. So it must emphasize on cash, the availability of cash. These are advantages. The disadvantage, it ignores time value of money. It assumes cash flow in the first year and cash flow in the last year the same. For example, cash flow in the first year 500, cash flow in the second year 500. Under this approach, these cash flows are the same, but the timing is different. But as I have seen in the first chapter, cash flow today is better than cash after some time. But payback period doesn't consider time value of money. And it ignores cash flows beyond the payback period. Look, for example, the payback period in the first project is 2 point something, and it ignores cash flow after that. It ignores cash flow after year 3, for example, after year 2.86. These cash flows are ignored. Cash flows after the payback period is ignored. This is another limitation. The same is true for project B. Cash flow after the payback period is ignored. And it biases capital budgeting decision in favor of short-term projects and against long-term projects. But our concern is not on short-term or long-term projects. Our decision criteria or our ultimate goal is to maximize wealth. So being short-term, being long-term doesn't matter as long as there is wealth maximization. But payback period prefers short-term projects. The shorter the payback period, the better the project is under this approach. So say this, there are two projects, for example, to project A and project B. Cash flow at year 0 or initial investment is given. Cash flow at year 1, 2, 3 is given. Which project is preferable? See all these projects.
A.
The second example. Why?
The cash flow, the period is equal, the cash flow is preferable.
Preferable.
Yeah.
We're talking about payback period. Why do you prefer project A?
It is the same.
Sorry?
It is the same.
It is not the same. It is according to wealth maximization, they are the same. But
we are using payback period.
Payback period is preferable A, yeah.
Yeah. Why do you prefer A if you are using payback period as a criteria?
More money is payback period in the short time. More of the money we have to invest.
Okay. Can you calculate the payback period for A and B? See it again. Follow. Is there another view? Which project is preferable?
According to the criteria, I think both projects have the same value. If we ignore the others,
because
they have the same payback period, 3 years.
So they have the same payback period. That's right. The initial investment is 100,000 for both. In year 2, 90,000 will be covered. in year 1, that means the remaining is 10,000. Period 2, 9,000. 99,000 is covered. Period 3, 100,000. So the payback period is 3 years. Project B, it is the same. In year 1, 1,000, the remaining is 99. Year 2, 9,000, the remaining is 90. In year 3, 90,000. So the payback period is the same. So all projects are the same. They have the same payback period.
Sir.
Yes.
But the fraction is different. The final fraction is different. I think 2 point something. The fraction, the last fraction.
How do you calculate that?
2 years and 1,000 over 100,000. In this case, the fraction is lower.
Sorry, I'm not clear with your question.
In terms of fraction. Yeah.
There is no fraction in this case. There is no fraction.
The value of money.
There is no consideration of time value of money in payback period.
Yes, in the payback method, there will not be time. We will not consider time value of money.
Yes.
But when we calculate the payback period, in the first case, in A, it will be 2 years and 1,000 over 100,000, the fraction. In the second B, 2 years and 90,000 over 100,000. The fraction is different.
There is no fraction. We calculate fractions if the total cash in the period, for example, in the previous example, let's go back to that.
Yeah.
For example, here in this period,
yeah.
After year 3, we only need 4,400 cash. But in year 4, throughout the year, the company will generate 10,000.
Of course.
So we don't need the full year to recover 4,400.
Okay.
That's why we are calculating fractions. But in this case, look, in this case, for example, in year 1, we are covering 90,000. The remaining balance is 10,000.
10,000, yeah.
In year 2, we'll cover 9,000.
The remaining is 1,000.
1,000. In the last year, in the whole year, this project will generate 1,000 throughout the year, full year.
Okay.
So there is no fraction here. Is that clear?
Okay. Good.
Yes.
According to the financial manager,
okay,
they are the same in payback period.
Yes.
But we have to refer, or we have to choose one project from the two. So we have to need other decision methods, or other methods we have to use.
Non-financial criteria.
Yes, other criteria we have to use. So this is the value of money. This is my project. The two projects, I am a financial manager. I will be preferably A1.
If you are considering time value of money.
Time value, because other criteria is fully, they are equal.
Yes, that is one of the limitations of payback period. Okay. So if we are using discounting methods, we'll see those methods.
Okay.
You will prefer okay.
ፕሮጀክት ኤ ጥሩ ነው ለኔ ማለት ምክንያቱም በአንድ አመት በመጀመሪያው አመት 90,000 ብር ማግኘት ሌላ ተመሳሳይ ፕሮጀክት ያስጀምረኛል ማለት ነው ያ ገንዘብ ካሽ በማግኘት ማለት ነውና
ኦኬ yes
ከዚህ አንፃር አንድ እሱ ነው ያኛው ግን 90,000 ማገኘው በሶስተኛ አመት ላይ በጣም ጊዜ ይወስዳል ባንዴ ብዙ ይሰጠኛል ግን ይቆያል ግን ዛሬ ማገኘው 90,000 እና ነገ ከሁለት አመት በኋላ ማገኘው 90,000 በጣም ብዙ ኪሳራ አለው ከቢዝነስ አንፃር ስለዚህ የፕሮጀክት ኤ በጣም ማሳመን ፈጣን ነው ሌላ ደግሞ ብዙ የተሻለ እንደ እሱን 10,000 ጨምሬ ሌላ ፕሮጀክት ያሰራኛል ማለት ሶ በዚህ ምክንያት መርጠዋለሁ ማለት
you are understanding time value of money and you are understanding the limitation of payback period
አይ ታይም ብቻ ሳይሆን የሰው ኃይልም ዛሬ የምከፍለው የሰው ኃይል ነገም በዚህ ዋጋ ላይ ላገኘው እችላለሁ። ስለዚህ ኮስትም ይጨምራል ማለት ነው።
Yes.
አንድ
Actually,
ቢዝነስ
that
በቆየ
cost
ቁጥር ኮስቱንም እየጨመረ
ይጨምራል።
ብዙ ፋክተሮች ይኖሩታል አብሮ የሚመጡ።
Yes.
ለምሳሌ ወለድ 90,000 ብር ባስቀምጥ ባንክ ላይ ወለዱ ብዙ ነው የሚሆነው። እሱን አስቀምጬ ባንክ ደግሞ የማበደር አቅም የመበደር አቅም ይጨምራል ማለት ነው። ብዙ ኢምፓክቶች ይዘው ይመጣሉ አብሮ። ስለዚህ ከዚህ አንፃር ፕሮጀክት ኤ ለኔ በጣም አሪፍ ነው የምለው።
One thing that you have to be careful is the selection criteria depends on the method used. We are talking about payback period. The payback period የትኛው ነው ክራይቴሪያው payback period ከሆነ የትኛው ነው ጥሩ ስትባል አሁን time value of money ምናምን ኮንሲደሬሽን የለውም እዚህ ላይ። አሁን ያልከው ኢሹ የሚመጣ በሌሎች ዲስካውንቲንግ ሜተዶች ላይ better to understand
ያኛው ገና
አሁን በፔባክ ፔሪድ ነው ጥሩ ብትል sorry for the interruption. For example, if this is my question and if the criteria is given as payback period and if your answer is A, you are X because under payback period criteria both are the same. Both are the same because there is no consideration of time value of money. So the decision criteria depends on, or the decision rule depends on the method used. Am I clear? We have another question.
በትምህርት ከፍ ብሎ መብረር ይቻላል። ናሽናል አቪዬሽን ኮሌጅ የናሽናል ኤርዌይስ እህት ኩባንያ ከከፍተኛ ትምህርት አግባብነትና ጥራት ኤጀንሲ ሙሉ ዕውቅናን ባገኘንባቸው በማስተርስ ዲግሪ ኤምቢኤ በስትራቴጂክ ማኔጅመንት፣ ኤምቢኤ በባንኪንግ እና ፋይናንስ፣ ኤምቢኤ በቢዝነስ ሊደርሺፕ፣ ኤምቢኤ በሪስክና ኢንሹራንስ፣ ኤምኤስሲ በኢንተርናሽናል ትሬድ እና ኢኮኖሚክስ ዘርፎች በእውቀት ለመቅረጽ የበቁ ፕሮፌሰሮቻችን አረንጓዴ መብራታቸውን አብርተዋል። በነገራችን ላይ በኬንያ ሀገር ከሚገኙ ስመጥር ዩኒቨርሲቲዎች በሚመጡ ፕሮፌሰሮች የትኩረት መስክ ትምህርቶቹ መሰጠታቸው ልዩ ያደርገናል። በምርጥ የትምህርት ስርዓት የተገነባው ናሽናል አቪዬሽን ኮሌጅ በመጀመሪያ ዲግሪ በአቪዬሽን ማኔጅመንት፣ በሆቴል ማኔጅመንት፣ በአካውንቲንግ እና ፋይናንስ፣ በማርኬቲንግ ማኔጅመንት አስተማማኝ ትምህርት ይገቢውና ራስዎንና ሀገሮን ይለውጡ። አድራሻ 22 አደባባይ ወደ ሾላ በሚወስደው መንገድ ላይ ናሽናል አቪዬሽን ኮሌጅ የናሽናል ኤርዌይስ እህት ኩባንያ ህልሞን እውን ያደርጋል።
You can write questions. What is cash flow? What is cash flow is Mohammed's question. There are two types of cash flows, as you have seen previously. One is the initial investment. Cash flow means maybe inflow, maybe outflow in organizations. Outflow, payment, cash payment by organizations. For example, if there is a new project, the company must pay for that project. That is cash outflow. And it is negative. For example, cash flow at year 0, negative 100,000 cash flow means the company is paying cash for new projects. Cash flows for after the initial investment, if it is a manufacturing company, if the project is a manufacturing company, cash flow after the initial investment means net of cash inflow from sales minus cash payment for cost. If it is a manufacturing, first the company must produce products. To produce, must purchase raw material. There is cash payment for that. That is outflow. There is payment for labor. That is cash outflow. There is payment for overheads, outflow. After production, there will be sales. It is inflow. So cash flow after the initial investment is the net one. Cash inflow from sales minus cash payment for costs represents this cash flow. So when you say cash flow, we are referring inflows of money and outflows of money. In projects, there is initial cash flow, the negative one. After the initial investment, there is net cash inflow for the organization. Cash received minus cash paid. Is that clear, Mohammed?
Yes, thank you. Yes.
Okay.
Yes, thank you. Yes.
Okay. Another question is so 3.44 payback period for the project. I think it is answered. We have seen the payback period calculation. Amount of time required to recover the initial investment. The initial investment or the initial cash outflow is 10,000 in our case. In the first year, 500 is recovered. The remaining is 9,500. That means 10,000 minus 500. In the second year, 500 will be recovered. So 9,500 minus 500, 9,000 remaining. In the third year, 4,600 will be recovered. So 9,000 minus 4,600. 4,400 is remaining. So up to year 3, 4,400 is remaining. In year 4, the total cash flow will be 10,000. So we are not needing the whole year to recover 4,400. So to calculate the amount of year required, the remaining balance, that means 4,400 divided by total cash flows during the period. 4,400 divided by 10,000, 4.4. So 3 plus 4.4, 3.44 years, which is the procedure to determine the payback period. I think it is answered by Sintai also. So is that clear? Is that clear? So according to project sustainability, which one is preferable? Another thing that you have to be careful is we're talking about financial criteria to select projects. But financial criteria are not the only criteria. We're talking about financial criteria because the course is financial management. I hope there is a separate course, project analysis and evaluation. Finance is one part of the project. It's not the whole. So other criteria will be discussed in another course. Our concern here is how to select projects by using financial criteria. Sustainability and others are non-financial. Is that clear, Solomon?
Yes.
Yeah. So let's talk about finance only here. But finance is not the only criteria. You have to know this. If you have another question, what about the second project, project X and project Y? Which one is preferable? By using payback period as a criteria. Is that project X or project Y?
Project X.
Project X. Because the payback period for project X is 2
years.
Right? 2 years. The payback period for project Y?
3 years.
Not 3. Be careful. Up to year 2, the remaining is 1,000, right?
Yeah, 1,000 over 80,000.
1,000 over 80,000. The result is? The result.
Zero point 0125.
2.125. 2.125. This is a payback period. So in this case, project X is preferable because the payback period is 2. In this case.
Not
So
2.125.
And what is that? And then? What's the result then?
2.0125. They are 0 between point and 1.
Is that 1,000 divided by
short period of time.
Yeah, 2.0125.
125.
Okay, thank you. 0.125. Still, project X is preferable. So this is.
Sir,
yes.
It is 2.125, not 0.
1,000 divided by.
No. 1 over 80. Yeah. Sorry, it's my mistake.
Yeah. Okay, it's okay. We'll use calculators.
Yeah.
Don't worry. So this is a payback period. So you have to know its advantage and limitations. The advantages is simple. The limitations, no consideration of time value of money, no consideration of cash flows after the payback period. And usually the payback period limitations outweigh its advantage. That's why we call it simple and dirty method. The other one is discounted payback period is also possible. Discounting means calculating present value. I hope you are familiar with the process to calculate present value. We can calculate the present value of cash flows, and still the procedure is the same. Only the first limitations can be avoided. No consideration of time value of money. That means, for example, in project X, the payback period, if it is discounted payback period, we have to calculate present value of 90,000, present value of 10,000 separately, and use that present value to calculate payback period. So we can avoid the first limitation. The first limitation is ignorance of this time value of money. But other limitations will continue, even under discounted payback period method. The only thing that we have to do is calculating the present value of cash flows. Other procedures are the same. Another method, non-discounting method, is accounting rate of return, or ARR. It is a measure of project's profitability from conventional accounting standpoint by using accounting reports. When we say accounting reports, we're referring reports from the financial statements of companies. The formula is average annual net profit divided by average investment times 100. This is a formula to calculate accounting rate of return. Average annual net profit, total profit divided by number of years. This is average one, or the mean. Average investment, book value at the beginning plus book value at the end divided by 2, if there is any difference. Sometimes initial investment will be there. Sometimes there will be additional investment. So beginning investment may be different from ending investment. So we have to calculate the average one. So simply divide it by 2. The decision rule is if accounting rate of return is greater than or equal to target accounting rate of return set by the firm, the firm will have its own target return. That means I will generate this percentage of my investment. Target will be there. Target will be there. And at the time of evaluating projects by using accounting rate of return, we can compare the project's accounting rate of return with the target. For example, if you as a manager sets a target rate of return as 20% as a target. This is a target assume. And if there is a new project, if that project's accounting rate of return is 18%, is it acceptable or not? Your firm's target return is 20, but the project is going to generate 80% return. Is this project acceptable?
No.
No, because? What's the reason?
Because it's lower than the target.
It is lower than the target. To accept the project, the return must be greater than the target return, greater than or equal to the target return. So this is the criteria or the decision rule. Let's see it by using an example. For example, a project requires 500,000, has a scrap value 20. Scrap value means the value of the project after completing its estimated economic life. Selling price after completing estimated economic life. For example, if it is building, it will have estimated economic life. Number of years that the building will serve the organization. After completing those years, we can sell it by 20,000. This is what we call it scrap value or salvage value. Assume the economic life is 5 years and the expected to yield profit after depreciation and tax during the 5 years, 40, year 1, 60, 70, 50, 20. That means year 1, year 2, year 3, year 4, year 5, 5 years. And assume the target accounting rate of return is 12%. The required is to calculate accounting rate of return and to decide whether this project is acceptable. The formula is average profit divided by average investment. The average profit is sum of these profits. Sum of this will equal with 240,000 divided by number of years, 5. So 2,400 divided by 240,000 divided by 5, it will be 48. This is average profit. And to calculate average investment, in this case, the beginning and ending is the same, simply divide it by 2. But you have to deduct the salvage value or the scrap value. This is outflow initially, but after completing the estimated economic life, the company will generate 20,000 cash. So deduct it from your initial investment. It means 500,000 minus 20,000 divided by 2. So beginning and ending is the same. Deduct only the scrap value. So you'll have divided by 2 and you'll have 260 average investment. So the accounting rate of return is average profit divided by average investment. That means 48,000 divided by 260 times 10 times 100, it will be 18.4%. The target accounting rate of return is 12.5. What will be your decision? Is this project acceptable?
Acceptable.
Acceptable because
It's the value is higher than the target ARR.
so the return from the project, that is 18.4, is higher than the target set by the management, 12.5. So the decision is accept. The project should be accepted. So this is accounting rate of return. If you have any question? This accounting rate of return has some advantage and disadvantage. The advantage is it is easy to understand, easy to calculate, because you can find accounting profit from financial reports, and the procedure is simple. And it considers profitability. It can be considered as the advantage. The disadvantage, it uses accounting income rather than cash flows. And as I've said in chapter 1, in managing business organizations, cash flow is king. But if we are using accounting rate of return as a criteria, we are using accounting profit, not cash flows. And we have seen the difference between accounting income and cash flows. They are different. Because in accounting income or accounting profit, it is possible to record revenues without collecting cash. It is possible to record expenses without paying cash. So accounting income is simply a number. But if we are using cash flows, we are using actual resource that can be readily available for managers to use and generate additional return. So one of the disadvantages, it uses accounting income instead of cash flows. It ignores time value of money too. Both payback period and accounting rate of return ignores time value of money. Okay, there is no salvage value in our country. So the depreciation computation method is different. Understand that in our country. But for general, that is for tax purpose. For general purpose accounting report, even in our country, in the near future, full IFRS will be implemented, and the valuation of assets will be different from the currently used valuation technique. I'm not going to discuss that. So, Mohammed, I understand your question. Okay, these are the two non-discounting methods. From the discounting methods, or we can call it modern methods, net present value is one. NPV, or net present value. Net present value, it is the net sum of total discounted benefits or cash inflows and total discounted costs. Simply compare the present value of future cash flows with the initial investment. Present value of future cash flows minus initial investment will give us net present value. So it represents worth of an investment in excess of investment itself. Worth of investment compared with the current investment. If we invest 10,000 today, for example, the initial cash flow, and if there is net cash flow after the initial investment, we have to calculate the present value of cash flows after the initial investment. That is the worth of the investment. Compare it with the initial investment. So the NPV method is a system of finding out excess or short of present value of earnings from investments over and above present value of investment itself. It will be more clear if we see it by using an example. So this is the procedure. The first one is find the project cost or the initial investment. Second, find future cash flows estimated for the project, the projected business. You have to find cash flows after the initial investment. Net of outflows, that means we have to see, we have to use the net. Net cash flow means inflow minus outflow. Inflow from sales minus outflow for raw material and other inputs. So you have initial investment and you'll have cash flow after the initial investment. The third step is select appropriate rate. Appropriate rate. And a period to be considered rate or discount rate. We can use the management's required rate of return as a discount rate, or we can use the cost of capital as a discount rate. We'll have detailed discussion in chapter 3 about cost of capital. So simply you have discounting rate or percentage. Know the period of time. Time and rate must be known, and find out the difference between present value of cash flows and investment cost. This is a procedure. So the formula is calculate present value of cash flows. I hope you remember this. This is the present value formula. Present value means future value over 1 plus r the power of n. We have seen this in chapter 1. But here we are talking about cash flow. Cash flow can be considered as future value. For example, assuming we are at year 0, cash inflow at the end of the first year is future value. That is the value of cash that will be received after a year. Cash flow after the end of year 2, it is future cash flow. So sum of cash flows, this one. Sum of future cash flows, sum of the present value of future cash flows minus initial cash flow will give us net present value, NPV. Cash flow, when we say cash flow, we're referring cash inflows at different periods, net cash inflows at different periods. R in this case stands for discount rate. C of cash flow at year 0 refers to the initial investment or cash outflows in the beginning. NPV, net present value, T, time. Only the denomination is different here. Simply, present value means, we have seen in the first chapter, present value, which is equal to future value over 1 plus r rate the power of n. This is the present value formula. In this case, we are using cash flows as a future value. Cash flow at time t divided by 1 plus r the power of t. This is a present value formula. We have to sum all cash flows, present value of all cash flows, deduct initial investment from that sum, so that you can find net present value. So the decision rule is accept a project if the NPV is positive. If it is positive, that means present value of future cash flows are greater than the initial investment. The essence of this NPV is we're changing the timing. Look, we are investing today to generate cash in the future. We are changing future cash. We are changing the future cash into present one. We are calculating the present value of future cash. So we are putting these cash flows on the same time zero. If we calculate present value of future cash flows, that value is the value of birr today. If there is current or initial cash outflow, it is the value of that birr today. So the timing of cash flow is becoming the same. So that we can compare cash that will be generated in the future with cash that we have to pay today to generate that. Equal timing. So if the future cash flows, the present value of future cash flows that will be generated by investing C amount of money today is greater than the initial investment, or in other words, if it is positive, accept. If it is negative, reject. Negative means the initial investment is greater than the present value of future cash flows. So no need to invest today to generate cash lower than our initial cash. For example, if our initial investment is 10,000 CO, that means if some of the present value of future cash flows is, let's say, 8,000, case one. No need to invest 10,000 to generate 8,000. So reject that investment. If your initial investment is 10,000 and if the present value of future cash flows from that investment is, let's say, 12,000. So 12,000 is greater than the initial investment. By investing 10,000 today, we'll generate 12,000. That means the result will be positive 2,000. So accept the project. So the decision rule is, if it is positive, accept. If it is negative, reject. This is an example. This is an example. Now you can remember the procedure. You have to know the initial investment. This is 100,000. You have to know cash flows. They are given 20, 30, 40, 40, 35. These are cash flows. Step 2. You have to know the discount rate, and you have to know the period 5. Those are given here. So the required is calculate present value, net present value, or NPV. What will be the net present value? You can use financial table. I hope you remember how to use financial table. Remember that. These are from the financial table. For example, we are interested to calculate present value. So at year one discount rate is given. It is 10%. Sorry, 10%. 10% discount rate. Year 1, year 2, year 3. Or you can use a formula, or you can use a financial table. The formula is to calculate the present value of this. Sorry, calculate the present value of 20,000 at the end of year 1. The formula is 20,000. 20,000 is the future value divided by 1 plus the discount rate is 10%. 0.1, the power of 1. To calculate the present value of this 30,000 over 1 plus 0.1, the power of, can you tell me? 2. For the third year, the same. You can use this formula, or you can use the financial table. From the financial table, you will find this. For year 1, 0.9091, year 2, 0.8264, 4, 5. After that, you can multiply this, multiply this, multiply this, multiply this, multiply this. I hope you remember how to use the financial table. you have financial table, okay. Shall I show you? Financial table እንዴት እንደምንጠቀም አረሳችሁም አይሆን?
አላወቅ ነው
ቻፕተር 1 ላይ ያሳያችሁም። Okay. Do you have the financial table?
I don't have.
You don't have? Let me share you via this message. Okay. You can find it in the chat box. Download it. Because I'm going to give you this financial table on your exam. You don't need to use these formulas. You as a manager, you have to know the procedures. And simply you can use the financial table. No need to remember formulas and others. Now you have the financial table, right? Do you have now?
No, sir. Where
Yes,
is
we
it?
have. Yes, we have. It is on the
In the
share
chat box.
screen.
You can find it from the chat box. I also shared this in our previous class. Probably if you are using mobile phones, it may be difficult to download it and open it. Okay. Okay, download it and let me show you how to use financial table. Instead of using formulas, present value, future values, you can use the financial table. In the financial table, there are different tables: future value, interest factor for $1 compounded at I% for n period, present value, interest factor for $1 discounted at I% for n period, and there is also future value for annuity, present value for annuity. Remember this in chapter 1. So our interest is to calculate present value. It's not annuity. Present value, table 2, that means table 2, table A2. This is a present value. Oh, is it visible?
Yeah.
Can you see it? The table that I shared.
Yeah, yes, yes.
Yes. So I'm going to show you how can you find these numbers from the table. The discount rate is 10%, this one. For the 10% discount period in different periods in 1, 2, 3, 4, 5. So from the table, for period 1, this is period 1. Period 1, discount rate. What's the discount rate? 10%. 0.99. Is that clear? 0.99. In the slide, period 1, 0.99. Period 2, 0.826. Period 3, period 4 at 10%. Period 5, period 6. It is up to period 5. These are from the financial table. Instead of using formulas, because it requires time, you can use these numbers. And In your exam, I'll give you the table, this table, or these numbers. Don't get confused, and you have to know how to use it. I hope it is clear now.
Yeah.
Once you find this discount factors, you can multiply. And you see the slides that I shared. Share ያደረኩት ስላይዱ ይታያችኋል?
Yes, sir.
Yes. So these numbers are from the table. You can use the table. From the table, these are the numbers that you can find at 10% discount rate for different pairs, or you can calculate the present value by using formulas, the formulas that I showed you previously. Future value over 1 plus rate to the power of n. In the first year case, for example, 20,000 divided by 1 point, the discount rate, 1.1, the power of 1. So the result will be the same here. Or you can multiply 20,000 by 0.9091. Multiply. So sum of these present values will be 122,078. So this is the sum of the present value of future cash flows. What's our initial investment in this case? What's our initial investment?
100,000.
100,000. So what is our net present value?
Can't be calculated.
Yes, 122,000.
078.
8 minus
100,000.
100,000. The result is
22,078.
Yeah, 22,078.
Yeah.
78. Is it acceptable?
Yes.
Yes. The reason is
Greater than 0 or
the criteria is greater than 0.
yeah.
If the present value of future cash flows is greater than 0, that means the investment is value adding. We are investing 100,000, but we are getting 22,078 extra from our initial investment.
What is extra?
Greater than the initial investment, that means. Value adding. 22,078 is added. Or in other words, by investing 100,000, we are generating 122,078.
Okay.
So the value added in this case is 22,078. Is that clear? Is that clear?
Yes.
Yes, that's clear.
Do you have any question? If you have any question. So the net present value is 22,078. So the decision is accept the project since its NPV is positive. So when it is the advantage of this NPV, it considers the magnitude and timing of cash flows. So time value of money is considered in this case. And it provides an objective criterion for decision making which maximizes shareholders' wealth. It is in line with shareholder wealth maximization. Shareholder wealth maximization. Sorry. Because, for example, in our previous case, our initial investment is 100,000, but the present value of future cash flows is 122,078. So the difference is 22,78. So this amount value is added. So it is consistent with wealth maximization. The value addition as a result of that project will be clearly shown if we are using NPV as a criteria. And it is the most conceptually correct capital budgeting approach for selection of mutually exclusive projects. If we are selecting mutually exclusive projects, what do you mean by mutually exclusive project? What do we mean by mutually exclusive? What is a mutually exclusive project?
accepting one project will be rejecting the other.
Yes, if you accept one, we have to reject the other. For example, if there are two projects, project one, let's use project one and project two. If the NPV for project one is, let's say, 22,078, the NPV for project two is, let's say, 10,000. Assume they are mutually exclusive. Which project is preferable? Project one or project two? Assume they are mutually exclusive. That means if we accept one, we have to reject the other. So which project is acceptable in this case?
One is acceptable.
Project one is acceptable because more value addition will be by accepting project one. So if we accept project one, we'll add more value than accepting project two. So this is. Let's consider the total cash flows arising from proposed project over its estimated life is another advantage. Remember payback period. Cash flow after the payback period will be rejected, but in this case, all cash flows will be considered. The disadvantage is it is difficult to compute and interpret compared with other non-discounting methods. So this is all about NPV. I think this is enough for today. If you have any question, you can ask. Is that clear?
But the table is the table, the present value factor. How to characterize? There are different types of in the tables, different percentages.
Different percentage.
Yeah.
The percentage will be given in the question. For example, in our example here, the discount rate is given 10%. This one.
Okay.
The percentage will be given. The discount rate will be given.
So only the given we have to take it.
Yeah, in this case, yes. But it's also possible to calculate the discount rate. If it is a cost of capital, it's possible to calculate the cost of capital. But we'll see how to calculate it in the next chapter. For now, consider it as given.
Okay, thank you.
Okay, if you have no question, this is enough for today, and thank you for listening. Have a nice day.
Good night, sir.